Live from Studio 2 at Bloomberg headquarters in New York, I'm Scarlett Fu.
And I'm Alex Steele. Did you watch the Oscars?
I did.
I spent
the whole thing.
2 hours on radio trying to find someone who watched the Oscars, and all
we'll talk later.
Was Scarlett. All right, let's get you a check here on the U.S. markets and where they stand. So it was kind of a heavy trading day. We are well off the lows of the session. The S&P now pretty much flat on the day, which is quite interesting after the last couple of days of relative weakness. The 2-year yield is seeing more significant selling in the front end, up by about 5 basis points. The 3-year came in okay. Demand was okay, but indirect bidders were actually quite solid, and we get $39 billion worth of 10-year treasuries coming tomorrow. Dollar yen, I just wanted to highlight this one. Yes, I appreciate we're flat, but the yen has been kind of the one thing that has changed that dollar weakness story as it sort of gains in strength there. So that's quite interesting, particularly as we go towards that March meeting. And Bitcoin, it's hard to get weird about risk, Scarlett, when you have Bitcoin over $72,000. I think, is it a safety or is it risk? And that's going to dictate, how you see the rest of the market.
Yeah, it depends on who you ask, right? Here's what else we are watching today. We're searching for value in a growth-driven market. We're going to go live to Chicago, where Romaine Bostic has an exclusive sit-down with John Rodgers of Ariel Investments to get specific stock picks, of course, and also John's take on how Paramount resolves its streaming business. Now, 1 year after the collapse of Silicon Valley Bank, we take stock of the banking industry. We've seen lenders like NYCB stumble and then get a $1 billion lifeline. So what's next? Who's better off? Who's worse off? And Alex, of course, let's turn back to the markets here because there's a new urgency to the question that hangs over us in 2024 so far. Is the record rally in stocks running out of steam or not?
Right. And then the answer to that is it broadening, right? And if it broadens and tech is weaker, does it broaden enough to support the overall indices? So it feels like everyone has their own answer. But this was quite interesting when it came to looking at that question. This comes from Bloomberg Intelligence. And this is the percentage of S&P sector stocks hitting 2024 highs for the year. And you can see here, over 50% of industrial stocks have hit highs for the year. That doesn't seem to say it's all about tech. And these are names like GE, potentially, Caterpillar, Eaton, those guys, not just Uber, which makes up a large part of the industrial index. Yes, of course, you do get technology, but even consumer discretionary, looking at just over 30%. Same with healthcare, same with financials, all 30% of those stocks hitting 2024 highs. So, Scarlett, you could make the argument that from this point of view, yes, you are seeing a healthier broadening out of the rally, which even if tech is weaker, maybe the indices can hold up.
Maybe. This is the question, and it's one that we're going to attempt to answer. So let's kick things off with JoAnne Feeney, partner and portfolio manager at Advisors Capital Management. JoAnne, it's always good to see you. Thank you so much for taking the time to speak with us. The big question here, whether we're in a bubble or not, whether the market has peaked. There are some magazine covers that have suggested that perhaps stocks have outpaced their fundamentals. You've got Barron's saying bet on the bull. You've got the economists asking how high can markets go. What's your feel here as we start to see the general public talk more and more about the stock market rally?
Yeah, Scarlett, you've just hit on my reading list for the weekend. Those are a couple of questions. We have to put in context what the market has done and what companies have delivered in terms of actual earnings and reasonable forecasts of future earnings. So, when you look at even the Mag 7, arguably some of the most expensive stocks out there, not all, but a good chunk of those, even they are not trading at ridiculous multiples, particularly when you compare it to the bubble we actually know and remember from the late 1990s. Right now, the Mag 7 is trading at about 28 times future earnings in the next 12 months. The market, excluding those guys, is trading about 18.5 times. Now, those are definitely above historical norms, but they're not ridiculously high. And when we look at the run-up in a lot of those bigger tech stocks, we see that they've actually been driven by significant increases in actual earnings growth and even forecasts just for the next 12 months from some good drivers, solid, observable, real customers, real products, as opposed to what we saw in the late 90s, which was a lot of slideware or phantomware, companies that didn't have products, didn't have earnings. That was really quite a bubble. This doesn't seem to be anything like that.
Right. So real earnings as opposed to let's count the number of eyeballs following a certain website, which was, of course, pets.com and so many of those other names back in the day. When we talk about the broadening of the rally, and this is something Alex had mentioned, we had noticed that industrials started to see a lot of improvement, but at the same time, they're leading declines today. And this comes right as strategists are increasing their forecast for the S&P 500 at the end of the year. What does it tell you when you have industrials like Caterpillar, like GE, doing better in an environment like this?
Yeah, so one of the things we've been talking about and we've invested in for quite a while is the structural need for greater infrastructure spending, not just in the United States, but around the world. And we're seeing that come to fruition. Now, last year was a tough year for the industrials with that steep and quick increase in interest rates. It made the cost of doing projects much more expensive. There was a time to absorb that, to reevaluate the timing of projects and how big they could be. So we did see a pause. But behind that is the infrastructure spending legislation in the U.S. that creates more funds to spend on bridges and railroads and airports and rural broadband, right, that is going to support spending for the next several years. And so I think one of the things we're seeing this year is a combination of secular growth prospects being now factored into valuations for the industrial companies, but also now coming out the other end of that pause in 2023 where inventories did build up, and now those inventories are being worked down. And so even if we don't get a big reduction in interest rates this year, which we are not anticipating, we do have that reduction in inventory, which sort of clears the decks and allows those companies to return to growth. And we think that's one of the reasons why the stocks have moved higher on recognition of greater earnings potential to come.
So, JoAnne, does that mean you just said you don't expect all the cuts? So is 3 cuts this year not your base case?
It is not our base case. We think that it's not impossible that we end up with 3 cuts, but right now the data don't seem to suggest that that's going to happen. The reason is because there's still an awful lot of tightness in labor markets that's still creating wage growth that's really higher than what would be consistent with 2% inflation, as is the Fed's target. And we just think that the Fed is going to be particularly cautious about moving too quickly to reduce interest rates. They've signaled very clearly that they want the data to be more confidence-inducing. While Jay Powell last week did say that confidence is growing and it's not that far away, it does suggest we'll get some rate cut this year. But we think the market might still be a bit too far ahead of what the Fed is likely to deliver. So don't count on that.
Yeah.
But there are plenty of ways to invest around it.
So I wonder, though, if that means that you expect a better economy or that inflation picks back up. I just was really interested by the New York Fed inflation expectation number, that the 3 and the 5 year actually increased by a good amount. Which one is it going to be?
It's, I think, probably that the wage growth being a bit higher, job market being a bit stronger is causing folks to recognize that inflation may not come down as quickly as they had expected. So our view, as you suggested, is one that where we think that the economy is in pretty good shape, right? Don't look a gift horse in the mouth. Job creation is strong. People's real incomes are rising now. That is, their nominal income is staying ahead of inflation, so the amount that they can stick in their grocery basket is higher than it used to be. And, the productivity seems pretty solid. Firms are recovering from a tough time in some cyclical areas of last year and are now seeing those inventories clear, whether it's in retail, industrials, as I mentioned, but also in the tech world. PCs, smartphones had seen inventory buildups in their supply chains, autos as well.
Yeah.
That's now clearing out. So there's a lot of good things happening in this economy that creates a good long-term investing environment for investors.
So it sounds like you're comfortably bullish when it comes to U.S. equities, and that goes beyond the big tech names. Having said that, there are still plenty of risks, plenty of things for investors to worry about, whether it's the wars taking place over in Europe and in the Middle East or the threat of cyber attacks. How do you position for that? How do you hedge against those kind of black swan events while making sure that you are collecting income and investing in good quality companies?
Yeah, Scarlett, one of the things I want to make clear is that we are really focused on those risks, and we want to build portfolios that give investors and clients a chance to have some insurance protections in their portfolios in case those risks manifest more strongly, right, than we'd all like to see. So it certainly is the case that there are pockets of the market that are expensive to a degree that makes them unattractive. So one has to be really careful about where one invests at this point in time. That's why we do like individual stock and bond investing. We can avoid the stuff that's too expensive relative to growth prospects. And then we like to build in those protections, like, for example, own some defense companies, ones that pay a dividend in addition to being a buffer against, say, geopolitical tensions flaring up even more than they already are, might be one way to go. Or own some, pharmaceutical companies like an AbbVie that has feet in both worlds of aesthetics and pharma.
JoAnne, we got to leave it there. Really great stuff. Thank you very much for joining. JoAnne Feeney of Advisor Capital Management. So if 2023 was all about the Magnificent Seven, this year may prove to be the Magnificent Many, M&M, a broadening out of the rally that's the Russell poised to outperform the S&P for a second straight month. We're going to go right to Chicago with our co-anchor, Romaine Bostick, with a very special guest.
Yeah, thank you. I'm here in Chicago with John Rodgers. He is the co-founder, co-CEO of Ariel Investments. John, pleased to have you here.
Great to be here.
Your firm started, 41 years ago, has always sort of had this ethos of patience, of stock selection, of value. Where do you find that in this environment?
Well, as you know, our logo is a turtle, so we really are patient investors. And we're finding our values in a couple of different places. One of our favorite areas is the healthcare area. We have a company, Invista, that's a great dental manufacturer and helps people, make sure they keep their teeth healthy. It's an extraordinary brand, a real moat around it. Other favorite healthcare companies, Adtalem. They are the largest provider for-profit education schools for nurses, doctors, and veterinarians. Really, it's, as you know, there's a shortage of nurses, a shortage of doctors, shortage of vets. Adtalem is extremely well positioned to do really well, less than 10 times earnings. Great CEO, Stephen Beard. So healthcare has been an area for us. Another area is just the sports-related, entertainment-related companies.
Well, let's talk about sports, because when you look at the ethos of this company, the idea of patience, I think nowhere was that more representative, at least in recent years, than your investment in Manchester United, the soccer club. You still have a pretty sizable stake in that, though I know it's down from what it was. But there are a lot of people who questioned that investment at the time. What gave you the confidence to stick by that?
Well, we think professional sports is a great, great place to be. And Manchester United has one of the best brands in the world. And more with the technology, and you'll be able to watch games on your phone at a moment's notice, whatever's happening around the world. We think Manchester United is especially well positioned because of its strong brand. It's hard to replicate that. It would just take forever to be able to do that. Now, the stock has not performed well. They put themselves up for sale. They had a partial sale, and so stock was sold at 33. We were able to sell a significant amount of our stock at higher prices. Now it's drifted lower. Because people presume that there won't be another sale for quite a while.
Right. Do you think there will be a sale?
We don't think so right now. We think it'll take a while for everything to settle down. But we know there's real value at 33, and the stock at under $15 here recently. You're buying the stock at a 50% discount to what we think the private market value, and we know that the company's worth $33. So we think if you're patient, to your point, you can buy it today at less than 15, and 5, 6, 10 years from now, be able to get full value for it going into the future.
You mentioned other stocks in the sports and entertainment area. You've also been involved with Madison Square Garden, and I guess partly through the spinoff, you ended up as an investor in Sphere.
Yes.
Yeah.
I mean, we love all three parts of the Dolan empire. There is a Dolan discount, which we think is overdone. We think that's given an opportunity to invest
because of who he is, or at least the perception of who he is.
The perception,
yeah.
Because he's done extraordinary things. Madison Square Garden is the world's greatest arena.
Okay.
It's iconic.
You're saying that sitting here in Chicago with the United Center in the background, but go on.
Well, it's true, but there's no comparison to the Madison Square Garden. It is a truly special place, and right in the downtown in New York City. And they executed a refurbishment more than 10 years ago that was done very, very well. It's exceedingly profitable. They do own the Chicago Theater. They own the Rockette Show, the Christmas Spectacular at Radio City Music Hall. So Madison Square Garden Entertainment's a great business. We think 20 years from now will still be there. People watching concerts, watching games.
Right.
Madison Square Garden Sports, where you can actually own the teams, the Knicks and the Rangers.
Sure.
Two iconic brands, both selling at less than 50% of we think the value of those businesses. So when you look at Madison Square Garden Sports, we think you're going to get If you're willing to be patient, you'll be able to get full value over time. And then, as you mentioned, the sphere.
What's the ballast, though, there? Because, I mean, on one hand, when you look at sports and what you would make from ticket sales, that can't be it. That's not enough of a business, is it? I mean, I know Dolan has done a good job. I mean, you mentioned, what was it, the Christmas show or something like that, where he has done a good job with intellectual property and basically seizing or at least holding on to the rights to certain things that I would think would give currency down the road.
Well, I think in both the businesses that I mentioned, there are opportunities, there are hidden opportunities. So Madison Square Garden itself, one, gaming is going to be very helpful to them as more and more people gamble, and you'll be able to have a sports book inside the garden, like we're going to have here at the United Center. You also, because they love the garden, there's a lot of value there. Whenever they renovate Penn Station, we should be really beneficiaries of that because we own the rights to that airspace. When it comes to the sports teams themselves, it takes a long time sometimes, but television, that's where it's really kept them generating all the cash flow. Seats are important, sponsorships are important, naming rights are important, but what the major networks pay and now the streamers are paying for that sports content, because people want to see live sports. And it's the one thing you don't record and watch later. You watch it live.
Absolutely.
So it's so valuable.
What's the future of that, though? Because the demand is certainly there, but the mechanism for delivering that, as you know, has become a lot more fractured. I mean, what is the future of television? Last time I checked, Ariel still had an investment in Paramount, which is obviously going through a lot right now, trying to figure out what its future is going to be.
We understand there are a lot of challenges with linear television, and the traditional bundle has, of course, completely fallen apart. But we still think that Sumner Redstone was right. The content is king. So if you're Paramount Global and you own the rights to CSI and The Godfather and Mission Impossible, and you've got the NFL and the Super Bowl and the Grammys and all these extraordinary brands that are there, all the active, 60 Minutes and CBS Sunday Morning and all the different things that you can watch, we think that content will be valuable however you end up getting it, whether it's through streaming, whether it's on your phone, streamed onto your phone, you're going to be in a great position. So we think content will still win out, whether it's sports or entertainment, whatever types of content that's there. And we think Paramount Global has the best content.
Okay.
And
do they have the management to actually execute on that vision? The idea they have the great content, but as you know, it's been an underperforming stock primarily because it is still very fractured, and who knows, maybe you end up with new management once Sherry Redstone finds a buyer. How confident are you that she can pull that off?
Well, we think that Bob Bakish has done an excellent job under an enormous amount of pressure. He used to run Europe, and he's great at understanding the international values there. I think Sherry's going to do what's right for shareholders and understands that it's what's right for her family. If you're going to sell that company for its maximum value, you're just not going to sell the part that she owns, but you're going to want to sell the entire enterprise where you'll get the synergies and the benefits. And there are so many large technology companies as well as traditional media companies that would be natural to want to buy Paramount Global. And you can get it for such a, we think it's really selling at a significant undervaluation here. And there's so much negativity around it. Everyone hates it. And you remember the great John Templeton always used to say you want to buy when there's maximum pessimism.
Right.
Clearly in broadcast television now there's a maximum amount of pessimism, which we think creates opportunity. As a value investor, as a contrarian investor, we love this.
Do you see a future of, I guess, traditional linear TV, or do you think all of this is going to migrate to a more streaming, sort of evergreen type of format?
I think eventually over the next couple of decades it'll get moved over to a streaming. But the nice thing, again, there's going to be all kinds of creative ways that you'll be able to access content, on your iPad, on your computer, on your phone, and there'll be ways to be able to sell advertising in all kinds of different types of ways, and to be able to just get what you need when you want it. I think ultimately it's going to, if you have the right content, it'll be monetized in a very profitable way. I think that's really important.
Do you or your folks, do you talk to the board or the management at Paramount from time to time? You have a pretty sizable stake, 4.5%, I think, as of the end of last year.
I'm not exactly sure the percentage that we own now, but we've actually been buying stock as it was making new lows the last few weeks.
I saw that.
Seeing that we think there are bargains there. We've happened to know, we've had a couple meetings with management in the last several months that have given us confidence that they are on top of their game. We've talked to board members and others and tried to make sure that they're going to be doing what's right for shareholders, and have come come back convinced that they understand they have a responsibility to all shareholders, not just Sherry. And I think that's something that maybe is not well understood on the street, that people think there could be a deal that would be Sherry friendly and not be friendly for everyone else. Right. But as I talk to my friends like Mario Gabelli and others, we have confidence that the management and the company will do the right thing for shareholders.
With the strategy, though, that you guys take at Ariel, is it more advantageous for, say, to be on that board, or with your current situation where you just have a sizable stake? I assume, given the stake, they'll take your call any day.
When we have size, we always have taken sizable stakes as small, mid-sized value specialists. We would never go on a board of a company that we own stock in at Ariel. It would really tie your hands to be able to move in and out when you need to be. But we try to act like an independent shareholder would or independent director would by giving management our best thinking, and not in a confrontational way, but in a collaborative and constructive way. Have you thought of this? Have you thought of that? Here are things we're hearing. Here are things that we think can be helpful to you. So we want to be a part of that management team's advice-giving teammates.
It's interesting to go look through the holdings at Ariel, because you do get some real insight into not just the strategy and ethos, but where you maybe see the buck going. I thought it was interesting, one of your largest holdings right now is a Jones Lang LaSalle, JLL, a big commercial real estate company, at a time where commercial real estate is really hurting.
It has been a very difficult time. As we know, all of our offices, so many offices now are people are going 3 or 4 times a week. It's just not like it used to be. But JLL has diversified dramatically. So they're not only just doing leasing, they're doing sales. They outsource real estate for large corporations, will take care of all their real estate needs. And they're global. So people maybe are not back in downtown America everywhere. But that's not to say that over in Europe that people aren't back, or over in Asia that people are not back. And the fact that JLL has become a global enterprise, we think it's really helped to balance out the risks and challenges that have happened here because of COVID.
So can that, for other companies out there in the commercial real estate space, can that diversification that you see at JLL, could that be the model that maybe helps some of these companies weather this storm?
Well, I think the big guys are the ones that will be able to weather the storm the best. CBRE competes with JLL. They are the 2 largest by far. There are a couple of others that are, have scale. But the vast majority there are locally focused. It'll be hard for them to be able to have the kind of international benefits that a JLL or a CBRE has.
How do you feel, though, when you look at the current economic environment and this idea that given that interest rates, which may have contributed to some of the pain we're seeing in the office space, obviously the pandemic is largely to blame, but if interest rates remain high, as a lot of people think they are going to remain, is there not going to really be that lifeline for maybe some of those legacy buildings and those second-tier buildings that are facing a refinancing coming up?
Well, I think we're getting used to interest rates where they are now. They're not, they're not dramatically high on a historic basis. They just look high because they came from zero, up to where they are today. So we think where we are now is not bad, and we think companies in real estate and other business will be able to learn to make do as we get used to where rates are. But also, we think the Fed's on top of their game now. They were late to the party, but now they're doing the right things. Inflation's back under control. Interest rates will go lower. And so we think real estate will be a place where you're going to be able to benefit. People, I think, have gotten too pessimistic, too gloomy around the real estate, and often, again, because they're looking just around their own neighborhoods. But it is different. Not only is it different around the globe, but it's often different. It's also different in small towns, Peoria or Rockford or whatever it is versus Chicago or New York or L.A. And we have to take that into account for these significant real estate companies.
I mean, I know that historically interest rates aren't terribly high, but obviously there's a whole generation of folks that really only knew basically 0, 1% interest rates. And this gets to a broader question, though. What do you plan for longer term right now? That we have to get comfortable with, 5% or 5.5%, wherever the Fed takes us? Or do we start to look longer term to an interest rate environment that could go back down, may not necessarily back down to 0, 1%, but something significantly below where we are right now?
I think something significantly below where we are right now, and that gives us a lot of optimism in real estate-related companies. Some of our favorites, whether it's Leslie's Pools or Residio or ADT, companies that are supplying products, and whether you're building a new home or just expanding an older home. These buildings-related products, these home-related products, we think will do quite well.
So you're relatively confident in the job that Jay Powell is doing right now. The economic conditions, this soft landing, this Goldilocks scenario that the market at least seems to think we have. Do you think that, Jay Powell delivered that or is on his way to delivering that soft landing?
I think Jay Powell and the Fed have done an excellent job getting back on track. Once they realized that inflation wasn't transitory and they had to get serious about it, I think they're doing all the right things, and I have a lot of confidence that a year from now rates will be significantly higher. We haven't gone into a recession. Yeah. We've really been able to balance everything in a very, very effective way.
And are you confident that, say, within a year from now, the U.S. will still be a better place to invest than overseas?
I'm very bullish on America. As Warren Buffett always says, we have the greatest system in the world.
All right. John, always great to talk to you. John Rodgers, of course, the co-founder of Ariel Investments. Back to you in New York.
All right, Romaine Bostick, thank you so much. Romaine in Chicago speaking with John Rodgers of Ariel Investments. And Alex, one thing I really liked what John said was he was referencing their corporate logo, which is a turtle. And in fact, if you look at it, it's a turtle, a really strong turtle, holding up a trophy cup. And it says, strong and steady wins the race.
I love that image too. And then Scarlett came up with the great idea that we should ask every company's CEO what their animal equivalent is. And I actually think it's quite brilliant because it's a turtle. So clearly it's strong and steady, but like it's working out.
It's working
put
out.
Muscle behind it.
Yeah. But I mean, some growth investors might decide to go with a rabbit, or maybe you go with a frog that jumps on lily pads before the lily pad sinks.
Yes.
There's all different ways of playing this.
You can tell where her mind went for like a good 10 minutes there. She was all spiraling out into that. But I also found the point on Paramount was actually quite interesting that like sentiment is so negative for linear TV that like is now, but it doesn't mean that things can't get worse. But maybe it does mean that at some point they will get better,
or
it will be a good solution.
It can still make money for a while. It's just making less money with each successive year. But that doesn't mean this isn't a business that works in the meantime. You just have to get out before it gets really bad, and that's the tricky part, right?
I mean, I feel like people are comparing it to a melting
iceberg.
Cube. Yeah, or iceberg. Melting iceberg. So it's like. At one point, does someone scoop in and try and save the iceberg? But, like you said, he was feeling pretty positive about Jerry Redstone making a bright deal for shareholders.
Yeah. I also like what he said about how, we don't necessarily want to go into a company and start getting on the board. We act more as independent directors and try to be more collaborative instead of bossy.
Yeah. Quite interesting.
All right. A lot more coming up on The Close. 1 year since the collapse of Silicon Valley Bank. We're going to speak with Mike Mayo about the health of the banking sector overall.
Plus, Bitcoin's rally continues up over 72,000. Doesn't show any signs of losing steam.
And as we count down to the closing bell, Lori Calvasina will be joining us from RBC. It's just about 3:30 p.m. in New York. This is the countdown to the close. I'm Scarlett Fu.
And I'm Alex Steele. And Scar, as we talk about sort of the broadening of the rally, you have to kind of look at the regionals. And have the regionals participated in the broadening of the rally? Like over the last year, regionals were up like 3%. They haven't done terrible in the last 2 months, but it hasn't been great. NYCB, on the other hand, New York Community Bank, is still down another 4% today, despite the bailout package yesterday. Investors are like, last week, they're like, guys, maybe the worst case scenario is off the table, but there's still a lot of work to be done.
Yeah, and we don't necessarily want to be there while the work is being done. You mentioned regional banks down about 3% since over the past year, but over the past year it's been a big roller coaster ride, of course, with the collapse of Silicon Valley Bank and then lots of different banks being sold off to others. And of course, this idea that you have to be big to survive right now.
Yep, exactly. Have to be big to survive. And even if you get big, that can also cause you pain. Just look at what happened with New York Community Bank. They got bigger, and that's in part of what hurt them because they had more regulatory requirements. So I wanted to dig into this a little bit because today does mark that 1 year anniversary since the collapse of Silicon Valley Bank. And it went from, plans for an emergency sale of its stock to VCs and startups just pulling their money out and U.S. regulators taking control. All of this sparking concerns at the time when contagion could spread throughout the U.S. banking system. Well, joining us now, Mike Mayo, Wells Fargo, Managing Director and Head of U.S. Large Cap Bank Research. Mike, it's great to see you. Now, we know you're the large bank guy. We get that. But do you think that all the issues with the regional banks are over? Are they solved? Or is it going to be this like cherry picking one by one will fall?
Well, banks, the biggest banks, have benefited really victory from defeat after the global financial crisis, 2007 to 2009, the regulation that was forced upon them, imposed upon them. I mean, big banks were going kicking and screaming, don't do this to us. That's helped the big banks become much more resilient. So the biggest banks have that resiliency that a lot of those mid-cap banks didn't have 1 year ago. So the issue with the smaller regional banks isn't that they're an imminent threat of some sort of contagion. It's that as you pass a certain threshold, $100 billion, you have the extra regulation without the benefits of scale.
Right, but is there going to be like a sweet spot between like 100 billion and 250 or 3 where like you're not mega cap bank, but like you're a little bit bigger and you can have regional scale? Like, is that going to be the next tier that you're going to start to cover or something at one point?
Well, the sweet spot is $4 trillion because those are the assets of JP Morgan. One day after Silicon Valley failed, I upgraded JP Morgan, made it my number one pick last year, and they've just been gaining market share in each one of their businesses, being very consistent, having the resiliency of both their loans and their deposits. 3 decades ago is when our country first passed interstate banking, when you could expand throughout the country. One reason was to create that sort of diversification that would prevent situations like what happened to Silicon Valley a year ago. So when it comes to the regional banks, it's not one size fits all, but to some degree, they've won the battle, but the war is still going to be tough because they don't have the same scale of technology, marketing, and regulatory ability to spread across a larger client base. So I do expect a lot more banking mergers over the next 1, 3, 5 years.
Okay, even if there are banking mergers, which there haven't been that many of, what I'm hearing from you is that it doesn't matter if they have, let's say, $200 billion in assets or even $400 billion in assets, because it's nowhere near what JP Morgan has. And so as a result, they will just, in comparison, look less safe.
Now, look, there are some banks that can do it through skill. I mean, Fifth Third's been very targeted with their approach, but just listen to the CEO of PNC. They have $500 billion of assets, and the CEO, just in January, and I went to visit him at the headquarters in Pittsburgh a little over a month ago, he goes, scale has never been more important. Deposits are rolling uphill. Corporate treasurers cannot unsee what they saw a year ago. And so corporate treasurers don't want to have to worry about the safety and soundness of their bank, according to the CEO of PNC. Therefore, they're saying they need to be a lot bigger, and they're one of the top 7 banks. So what does that mean for everybody else?
So what's going to be the catalyst for that consolidation to take place?
Well,
is it more marking to reality some of the commercial real estate loans?
I think you've had these unrealized securities losses.
Yeah.
And frankly, I've been on your show, and last fall I was saying it's fantastical to impose a liquidation analysis on banks. And if you imposed a liquidation analysis of the S&P 500, over 1/4 of the banks would have negative equity. So that was inappropriate and an opportunity, investing opportunity for the last 6 months. So I think in terms of scale and size and diversity, that's what you're going to continue to, invest in, and some banks will have it and some won't.
So let's get to one of your top picks, and that's Citi. So there was a New York Post article talking about restructuring of the century when it comes to Citi and sort of the behemoth job or the huge monster job that they have to do. And you said that that's wrong, that like they can actually do it. Talk us through it.
Well, look, Citi is remarkably consistent. They've failed their last 12 restructurings.
Okay, that doesn't bode well.
That was my attempt at a joke there. But everything's turned upside down for Citi. As you know, I was very negative during the global financial crisis, and I had my sell at $480 and wrote a book about this and everything else. And now I'm really emphatically calling the turn here in Citigroup. It's my number one pick ahead of JP Morgan right now. And I think 13 is the lucky number for Citigroup. And I think they've never been successful with their restructuring before, but this one's different for 2 reasons. Number one, they're selling businesses equal to 10 to 15% of their revenues. And number two, they're going to a line of business structure, 5 lines of business. And you say, well, who's done that before? Well, I'm wandering our research floor at Wells Fargo, and I run into Chris Carey. He's the consumer staples analyst. We don't always talk to each other that much. And he's like, this sounds like Procter & Gamble. So we publish a report. Procter & Gamble 5 years ago, they sold off businesses equal to 10 to 15% of their revenues. They consolidated their geographical and functional and other functions, they called it the thicket, into 6 lines of businesses. And you know what? He said, when they first did it, it was kind of a big yawn. People didn't recognize what was happening at Procter & Gamble. And then, according to Chris Carey, this has become one of the best turnaround stories he's ever seen in decades. 2 weeks from this Friday, Citigroup will be done with the decisions for its org simplification project. So 5 lines of business, delayering management from 13 down to 8 layers, ridding a lot of co-heads, co-reporting, co-ventures, and committees. And they've done that in 6.5 months. So I think 2 weeks from Friday, it's going to be kind of, you won't feel the earth move. If you're at Citigroup in the building, it's not going to shake. It'll be like a butterfly just flying off and away. But you're going to come back in 2 years and go, wow, that was a momentous occasion.
All right, the flapping of the butterfly wings has long-lasting impacts. All right, Mike Mayo, thank you as always. Mike Mayo, of course, the senior banking analyst over at Wells Fargo. Coming up on the close, we're going to take a look at Bitcoin. It passes $72,000 for the first time ever. More on that incredible rally. And, of course, the ETFs that are helping to drive it. That's next. This is The Close on Bloomberg.
All right, Bitcoin topping $72,000 mark. I feel like a broken record with this. Gains for this year now, over 70%. Want to get more on this? We're joined by Bloomberg crypto reporter Yueqie Yang. Yueqie, why? Why is it moving higher right now? How much more juice is there? I feel like I could have this conversation every day so far this year.
Yeah, so we're really seeing interest across Wall Street, both from institutional investors as well as on mainstream from retail investors. I think this is a unique asset class where you have a lot of retail participation, but then starting this year really with the momentum from Bitcoin ETF, you're seeing the big players coming in as well. Last week we reported that some of the big banks, they are starting to make the Bitcoin ETF product available to their wealth management clients on an unsolicited basis. And proponents of the Bitcoin industry will point to movements like this to say that there's really more momentum and more actions to come in the price.
Okay, so wealth advisors might be making that pitch, or firms might be making that pitch, but it takes a long time for the take-up to actually happen. So how much of this is just momentum and this idea that, the Bitcoin ETF has come out, or the series of Bitcoin ETFs have come out, and it's driving interest. And of course, the Bitcoin ETFs themselves are rising because Bitcoin is rising. It's just this, circle that doesn't stop.
Mm-hmm. Yes. And we know that retails are coming back into, there's renewed interest from some of the offshore crypto exchanges. You can see that retail participants are levering up. And there's sometimes warnings that we start to hear now from traders and analysts saying that people might need to start to be careful with the kind of leverage that they're using. But still, there's more events coming up. For Bitcoin itself, there's the halvening event that's coming up in April. Mm-hmm. That will reduce the supply of new Bitcoin tokens mined by Bitcoin mining companies. So some people will attribute that to another possible momentum to drive up the Bitcoin price.
Here's a question. I feel like at some point in the time of Bitcoin, it was tracking tech. And so when tech went up, so did Bitcoin. Is that correlation no longer exist? It no longer exists?
I think Bitcoin still increasingly has its own narrative. For the most part, people talk about Bitcoin potentially being used as an inflation hedge. I'm not sure that has necessarily panned out. Mm-hmm. But for this year, really, Bitcoin has its own unique drivers that's associated with some of these regulatory actions and the technical process of halvening. And I don't think these will necessarily apply to the tech stocks.
That's a great point. Yueqie, really appreciate your joining us. Yueqie Yang, of course, covers the crypto market structure. And as Alex says, she could be on here every day talking to us about the rise in Bitcoin and the rise in Bitcoin ETFs as well. So when we look at our stock of the hour, we're going to move away from Bitcoin, at least for today, and take a look at EQT. And this is in Alex's wheelhouse. It's a U.S. nat gas producer and agreed to buy back its former unit for about $5.5 billion in stock. This is Equitrans Midstream. Alex, what's going on here? They spun it off and now they're buying it back?
Yeah, and the market doesn't like it. That stock down about 9%. It's the worst performing stock within the S&P. This is basically all about the Mountain Pipeline. So it's going to bring natural gas from Appalachia and the basin, Marcellus Basin, to the southeast coast, mm-hmm. and then also maybe towards the Gulf Coast to then be exported. But it's been really hard to get this done. And the pipeline, what would move more of EQT's natural gas than anyone else's, so it just made sense to kind of roll it up. But this would be more of a long-term synergy play at the end of the day, rather than a short-term.
Okay, and this Mountain Valley pipeline project is apparently really controversial. What specifically is controversial about it?
Yeah, no one wants pipes in the ground near their house. It's like
it's a NIMBY thing.
But also when you cross state lines, all the state requirements are going to be different, and that's a big problem too. Not to mention all the federal as well, and it's just really hard to get stuff built from that perspective.
But once it's built and once it's there, there's money to be made.
It's like, there's got to get to that point. So that's knocked down by 9%. All right, coming up, Lori Calvasina, head of U.S. equity strategy over at RBC Capital Markets. One of my faves. She'll be joining us right after this. This is The Close on Bloomberg Television. Happy Monday trading.
This is the countdown to the close. I'm Scarlett Fu alongside Alex Steele. And Alex, another mixed day. It feels like we're constantly waiting for the next catalyst.
I know, right?
And, once we get it, we're like, okay, what's next? What's next?
But we supposedly got the catalyst, and that didn't really do that much.
No.
We're supposed to get one tomorrow with CPI. Yeah. Is that going to actually do that much?
No, we're going to look forward to PPI.
Right, and then exactly. In the meantime, S&P is pretty much flat. But within that, I do find it interesting that S&P industrials are the worst performing sector within the S&P. That's a builder story in essence. You have Builders First Source is the worst performing stock. I couldn't find anything super sexy about that, but nevertheless, worst performing sector there and stock. Boeing also part of that as well. You have the NASDAQ 100. I mean, slightly lower, but like nothing to write home about. And EQT, we were just talking about it, off by almost 9%, but that's an idiosyncratic kind of story. So it's down, but I don't know. Do we need to make a big deal about it?
I think it's down after, this is an S&P 500 that has closed at record highs 16 times this year. So you got to take it all with a grain of salt. And of course, you have the Dow Industrials outperforming today. To your point, industrials have been doing a little bit better, even if they're not doing so much better today. Romaine spoke earlier with John Rodgers, the founder and chairman of Ariel Investments. They had a great conversation about value investing and specific companies, but John also gave an outlook on the overall macroeconomic situation. Let's take a listen.
I think Jay Powell and the Fed have done an excellent job getting back on track. Once they realized that inflation wasn't transitory and they had to get serious about it, I think they're doing all the right things, and I have a lot of confidence that a year from now rates will be significantly higher. We haven't gone into a recession. We've really been able to balance everything in a very, very effective way.
For more market analysis, let's welcome Lori Calvasina. She is head of U.S. equity strategy at RBC Capital Markets, and she joins us here in studio. Lori, great to see you.
Great to see you, too. Thanks for having me.
So John was talking about how the Fed has done everything right, and it looks like we're going to get this soft landing. And, of course, the numbers when it comes to the economy are pretty solid, even with jobs, showing a slightly disappointing read if you look at it over a 2-month period. What does that mean in terms of the rotation out of big tech and into other parts of the economy?
So I think it's a great question. It's probably one of the biggest things we've been talking to people about lately. And you're really seeing this rapid rise in GDP forecasts for this year. So we track on the consensus data on Bloomberg. Back in mid-February, before I went away on spring break, the forecast was for 1.6%. And when I got back, it was all the way up to 2%. I thought I was reading something wrong, just in terms of how quickly. And you're seeing most of the quarters of this year getting an uplift. That's important because I think there have been a lot of reasons why big tech and the Mag 7, so to speak, have done well. Part of that was, there are a bunch of reasons, but part of that was because there was this idea, and we see this post-crisis, that we were stuck in this sluggish economy and that we were kind of running, slightly below average, kind of not quite at stall speed, not recessing, but just not that great. And that's typically an environment we see historically that growth stocks and large caps do well in. When GDP moves above trend, and trend is about 2.5% or so since the late 70s, that's when small cap, that's when cyclical, that's when value tends to outperform. So we're not there yet, but we're getting there very, very quickly.
We're not there yet, so that accounts for some of the churn that we see regularly. Yeah. In the meantime, you look at job layoff announcements, certainly from the tech companies, that continues to grab a lot of headlines. the productivity gains and the profit gains that we're seeing in those tech companies, does that not more than make up for it, but does that allow investors to kind of look past that and focus on the profitability picture?
I think to some extent, and I'll say another thing I've been talking to people about in regards to the layoffs is I think you have to look at the whole kind of COVID to now period if you want to really understand what's going on. And back in 2000, we had sectors like industrials, which did layoffs as big as what you saw back in the GFC, back in the tech bubble. They really haven't had to do much recently. We've seen a little bit of an uptick, but you can squint and miss it. If you look at tech and financial services, which we're kind of all at the epicenter of, they didn't lay anybody off during COVID, right? Everybody went to work from home. And so the layoffs you've seen in tech the last couple years, I think, are making up for that. And when I look at the tech layoffs and the challenger data, it really kind of pales to what we saw last year. So it is kind of where most of the action is, but still nothing to get all that angsty about.
So it's like a normalization versus something more dramatic. You guys have some great sentiment trackers. What's sentiment right now?
So sentiment, my colleague Amy Wu Silverman calls it begrudging bullishness, and I think that's the right way to put it. It's not like when we get out and talk to people, they're like all excited and they're partying like it's 1999 or back in the 20s. But I do think that positioning, especially in regards to the big cap tech companies, did get pretty extended. If you look at AAII, I think that tells you the best story. Net bullishness has been hovering around 1 standard deviation above the long-term average, kind of similar to where we were last August, but not quite a reversal of where we were in October 2022, where you were 2 standard deviations below the long-term average. Sometimes you do go up to 2 standard deviations plus, and we haven't done that. But you are at a point where historically the market's kind of traded flat on a 3-month forward basis and had forward gains on a 12-month basis, but kind of a bit below trend. I've been telling, frankly, I'm really surprised we haven't seen a pullback so far this year because we've been hovering around that 1 standard deviation mark since December.
Do you think, though, that we'll be able to see enough of a rotation in things like industrials or small caps or other parts of the market that's not big tech that makes up for big tech maybe stalling out?
I think we can. It doesn't mean we're not going to trip and fall down at some point, and that could be the thing that takes us from that 1 standard deviation mark to something more reasonable. But I don't think you have to fall super, super hard because I do remind people, the small caps are tiny, right? I mean, especially in regards to the Mag 7. You just take a little bit, kind of a drop or two, if you think of it in water terms, out of the Mag 7, out of the big cap growth companies, put it into small caps. It's really kind of a flood if you're looking at it from a small cap perspective. So I think you just take a little bit out, let them take a little bit of a breather, have basically more of a catch-up trade with the rest of the market, and then we'll see where we are. But I think we're really middle innings on things like value and small cap and financials right now.
Okay, middle innings seems to be a common theme here from our conversation with you. You're having a lot of conversations with clients about the election and positioning for that, and we're getting details of policy hints from President Biden. Of course, he also released his budget proposal as well. What are you hearing that has you kind of thinking ahead to what investors could actually tangibly do?
So, it's interesting. There's a big difference in conversation between non-U.S. investors and U.S. investors. And I think if you talk to the U.S. crowd, they say it's kind of early. We don't know a lot. It's probably going to be a split Congress. But you talk to non-U.S. investors and they're very focused on we need to do some things here. So they're sort of sensing a big difference in foreign policy between the two candidates. And I think really that translates into a kind of if Trump wins and the Republicans do well, more of an isolationist U.S. foreign policy, a pro-U.S. trade that could translate into a pro-small cap trade. We've seen that happen in the past under Trump around political dynamics, trade war, cutting corporate taxes, that sort of thing. So that's one conversation we're having. But, I do think in general it is a bit too early to do anything major. There's nervousness from non-U.S. investors about healthcare stocks, but there's interest in financials because, again, they're thinking about a Republican sweep scenario and Trump winning, and they think that equates to a better regulatory environment for banks.
That's really interesting. Lori, really appreciate your joining us and here in studio as well. We welcome you to come back anytime. Lori Calvasina of RBC Capital Markets. Begrudging bullishness is the line that I'm going to remember here from our conversation with Lori. As we count you down towards the closing bell, we have an S&P that's down 0.1%. Full market coverage starts right now as we take you to the bell and beyond.
Beyond the Bell, Bloomberg's comprehensive cross-platform coverage of the U.S. market close starts right now.
We're about 2 minutes away from the end of this trading day on this Monday. Scarlett Fu and Alex Steele here, counting you down to the closing bell and here to help us take you beyond the bell with a global simulcast We have Carol Massar and Tim Stanovic from the radio studio. Of course, welcome to our Bloomberg Television viewers, Bloomberg Radio listeners, and our YouTube audiences worldwide as we parse through some important milestones of this trading day. I don't know how many milestones that you've seen today, Carol, but it just seems to be
I think the milestone comes tomorrow.
So you say. You don't know that's going to happen. It could be a snooze or two.
It could be a snooze. What, tomorrow's CPI report? It could be, but at least it gives us a focal point and something to kind of talk around. Having said that, it does feel like a little bit of a mellow day and that we're just kind of waiting for that, and then we're waiting for next week's Fed meeting. We do have some earnings, though, after
it's time to take bets. Another day, another record for Bitcoin. Crossing the $72,000 mark for the first time, Alex. Up another $2,500 in the last 24 hours. We just did a really kind of a fun story about 1,500 millionaire wallets that are created each day. Have you guys seen this? It's among the most read in the last hour, thanks to the rally that we've seen in Bitcoin this year. It's not at the high that it was back in 2021, where there were thousands created each day. We also don't know if these are individuals or if they're like larger entities that are
I just kind of avoided that, Scar, because I'm not one of them.
That's what I said, too.
Like, all right, it's not me, so whatever. Also, like, I hate to say this, but what goes up can also come down. So, like, are you holding Bitcoin for the next 30 years as a diversifier, or are you going to be actively trading it, in which case, when it goes down, are you going to be selling and then it gets to be in a world of pain?
Number go up.
Tell us how you really feel about it.
I'm just jealous it's not me who's in Bitcoin.
Both.
All right, there are the closing bells. Look at that. There we are. Okay, we wrapped up one day of trading here in the U.S., and it was really boring. So the Dow Jones ended up by about 0.1%, but volume was really light. The S&P down by 0.1%, the Nasdaq up by 0.4%, but again, volume all light. I wonder if it's going to be a little sell into the news, buy the news scenario, Carol, but I agree with you. It's not been that exciting on a headline level.
Oh, my God. Right. It's been really kind of mellow, to say the least. All right. S&P 500. Let's just give you the breakdown, though, folks. 292 names actually gaining in today's session, 209 to the downside, and Scarlett 2 unchanged.
Yeah, we are marking time before CPI tomorrow, before PPI and retail sales on Thursday. You look at the sector performances, it is a mixed day overall. Yes, there are definite pockets of red. You have industrials, which had been doing fairly well, leading the decline off by 0.5%. Boeing is a big reason why. Consumer discretionary and REITs also in the red by 0.5%. On the flip side, your gainers include materials, that's Albemarle and Newmont, energy stocks, and consumer staples.
All right, guys, let's get to some of the individual gainers, if I may. Moderna, check it out. Number one gainer in the S&P 500 and the Nasdaq 100 today. That stock up almost 9%, 8.7% to be exact. Really continuing to see upside momentum, if you will. Rallying after a government trial website shows that the drug maker is starting a mid-stage study to test its experimental cancer vaccine in patients with a form of skin cancer. The trial, by the way, in collaboration with Merck, but that sent that stock definitely higher in today's session. Got a twofer for you. IMAX and Warner Brothers Discovery. IMAX up about 4% in today's session. Warner Brothers Discovery, that was a top gainer in the NASDAQ 100. That one was up about 3.9%, Warner Brothers. Actually, I should say IMAX coming out saying it set a new record in global market shares with Dune Part 2. I haven't seen it. I don't know if Tim, nope.
Saw Part 1.
You guys
haven't seen
it?
Part 2.
I have not, but I also want to mention, of course, IMAX got a big shout out. The CEO got a big shout out at yesterday's Oscars from the Oppenheimer producers.
You're right, they did. All right, so good stuff. So anyway, so they're definitely part of the narrative today and definitely rallying in today's session. IMAX, as I said, set a new record in global market shares with Dune Part 2, notching 22% of the global box office in the second weekend of Dune Part 2. Legendary and Warner Brothers are the studios behind it, so that's why you saw probably Warner Brothers maybe also popping as well, up 3.9%. One last name, MicroStrategy, if we bring it up for you guys, rallying to its highest in, I think, 24 years, up, 4% here in today's session. I scratched my head with anything to do with Bitcoin, but here we go. Bought another 12,000 Bitcoin for almost $822 million, the second largest purchase by the company since it began buying it almost 4 years ago. So now they've got total Bitcoin holdings to around 205,000 tokens or more than $14 billion. Those tokens bought between.
Alex is covering her ears right now as you talk about Bitcoin and MicroStrategy.
Well, no, I don't understand. Is it just because of the value and that's it?
I'm back to I'm just Ken right now.
Okay.
That's where I am.
I'm just Ken?
But I'm totally listening to you. I'm just Ken.
I thought you said I just can't.
No, I'm just Ken.
Is that the only one who didn't watch? I didn't watch last night.
I watched the whole thing. The whole 3.5 hours.
Late.
Scarlett's the only person I found who watched.
Nope.
Yeah.
Carol
Aside
did
from
too.
Ethan Ranganathan. Oh, okay.
Carol
It
watched the whole
started
thing.
at 7 o'clock.
Yeah,
It
too
was
late.
early. Done
Way
by
too
like
late.
10 o'clock or whatever.
Way too late.
No.
I'll catch the clips later today.
Google
hey, I
I'm
do
just
want to
Ken.
talk about some of the decliners. I want to start with shares of Meta Platforms down 4.4% on the day today. It did fall as much as 5.9% earlier in the session, but still, even with the close right now, its biggest decline in about a year. This after former President Donald Trump reiterated in an interview with CNBC that he's against banning the Chinese-owned social media app TikTok because it would actually aid Facebook and make Facebook bigger. This is a sentiment that he shared several times over the last few weeks. Should remind you, it's up 36% so far this year, up nearly 200% last year. So a decline of just a little over 4.4%, putting that into context a little. Scarlett, you mentioned Boeing. Shares of Boeing finishing the day down about 3%. This after the U.S. Justice Department opened a criminal investigation into the mid-air blowout of the fuselage panel on the 737 MAX 9 back in January. We did hear from Transportation Secretary Pete Buttigieg yesterday that the FAA will rigorously assess Boeing after that blowout. Also, the head of Delta Airlines told Bloomberg on Sunday that he expects further delays to the 737 MAX 10 variant, which is still not yet certified. Shares of Boeing down 26% so far this year, lowest since November of last year. And here's one for Alex. EQT Corporation, among the worst performers on a percentage basis in the S&P 500. U.S. natural gas producer agreeing to buy back former Equitrans Midstream Corp for about $5.5 billion in stock. Shares closed down 7.7% today. This is the latest flurry of deals in the oil and gas pipeline industry, but investors sending shares lower of the acquiring company today.
All right, I'm going to play Romaine for a second. Can I just add one more gainer?
No, Romaine will add
Wait, we got Oracle, guys.
Oh, we do. All right, so let's go there.
We have adjusted EPS of $1.41, beating the consensus estimate of $1.38. And then let's look at the different revenue lines. Overall revenue adjusted was $13.28 billion, bang in line with what analysts had anticipated. But if you look at cloud revenue, it was $5.1 billion, slightly higher than what analysts had anticipated, $5.06 billion. Oracle says cloud services and license support revenue was up 12% to $9.96 billion. The stock moving up right now about 3% in after-hours trading. It has also maintained its quarterly dividend at 40 cents a share. Yeah, decent operating margin too, right? That third quarter adjusted operating margin, 44%. That's above what the street was expecting. I mean, the stock's up on the year, up about 8% here. So definitely continuing a move to the upside, as Scarlett mentioned, now up about 2.5%. 3% even, as it bumps even higher.
Okay, looking at shares of Vail Resorts, ticker MTN, down about 2.2% in the aftermarket. The company sees fiscal year total reported EBITDA $847 to $889 million. Second quarter net revenue coming in at $1.08 billion, shy of estimates of $1.15 billion. The company does see fiscal year net revenue, or fiscal year net, I should say, $270 to $325 million, saw $316 to $394 million, so that came in below estimates. Second quarter EPS $5.76, coming in below estimates of $6.08. Again, shares down about 2.2% in the after hours.
I should point out the CEO saying in the results, given unfavorable conditions across our North American results, we're pleased to say that we are basically resilient at the end of the day, that their ancillary businesses like ski and ride school and dining and rental businesses actually had strong growth, even though overall it was a little bit lighter than that. Approximately
42% lower snowfall across our Western North American resorts through January.
Yeah.
That is... as you know,
and then what do you do? Then you
warming.
have to pay for the snow, right? Then you have to have a snow machine that's more expensive.
Only,
but then the rain,
only if it's warm enough to make it.
Right, and then the rain destroys all of it anyway.
Yeah.
Because it rains all the time.
Depends on where it's happening. They got a lot of snow in the last few weeks.
Right, and this is important because you guys, Tim was a ski bum and worked there, so that's why I was like, you got to break this because
the glory days.
You do the ski things.
Appreciate it.
Which mountain did you ski, Tim?
I lived in Vail. I skied Vail, Beaver Creek. I skied Arrowhead. Yeah, I was doing 100 days a year after college.
Huge.
Yeah, now I do none. So that's the way it goes.
All right. I don't know if there's AI in skiing, but I just want to mention another headline from Oracle. Demand for its Gen 2 AI substantially, that's their word, exceeding supply. So getting a little bit more of kind of the AI narrative and story, if you will.
It feels like they're setting the agenda for the conference call later on.
AI. I mean, to be fair, the stock is up almost 10%. So it was also cloud infrastructure contracts and new ones that really seem to do and deliver really well.
All right, good. And I just want to mention Advance Auto Parts. I'm sure you guys were on it. It was up 3.7% just at the close. Wall Street Journal saying activist Third Point has a stake in the company. So
interesting.
So we did see that one pop just in the last few minutes of trading. This was before the close. All right, guys, that's a wrap. Our cross-platform coverage, radio, TV, YouTube, Bloomberg Originals. We will see you again. We call it Beyond the Bell. We'll see you again, same time, same place tomorrow.
All right, we see shares of Oracle moving higher in after-hours trading, so we're going to take a deeper dive into those results from Oracle, the software company. This is The Close on Bloomberg. Welcome back to The Close. I'm Scarlett Fu. Let's get you a recap of how markets closed on this Monday. It was a waiting day, a waiting game, really, for the CPI data tomorrow. And, of course, PPI, wholesale inflation and retail sales on Thursday. So equities taking a bit of a breather with the S&P 500 losing 0.1%. We also had bonds falling. So bonds falling, and so yields moving higher across the curve, although a little bit of a change there with the 10-year yield moving up only 2 basis points now at 4.09%. The VIX did pick up a little bit there at 15. It's above 15, but still well below the low 20s that we had during last October's sell-off. And, of course, 1 year ago today, when Silicon Valley Bank had just failed, the VIX was at 26, so we've come down a lot since then. One thing that continues to run higher is Bitcoin. It climbed to as high as 72,000, still above that level right now, up 4% on the day. A lot of anticipation that Bitcoin will continue to have momentum heading into the halving in April. In terms of individual movers, we mentioned Bitcoin. Let's stay with it because MicroStrategy has become a proxy for the cryptocurrency. CEO Michael Saylor has been buying Bitcoin as an alternative to holding cash and, of course, as an inflation hedge. Moderna gaining more than 8%. That is a 2-month high following a notice that it's running a new skin cancer trial with Merck. Boeing, the worst performer of the Dow Industrials, it confirmed that the DOJ has opened a criminal investigation into the mid-air blowout of a 737 MAX fuselage panel back in January. Year to date, if you look at how the stock has performed, it's lost more than 25%, now down 26% since the end of last year. And yet another deal in the oil and gas pipeline industry. We have EQT declining 7.75%. The nat gas producer is buying back its former unit, Equitrans Midstream. The price tag is about $5.5 billion in stock, as vertical integration is something that is back in style right now, at least for this sector. All right, it has been 1 year since the collapse of SVB, as we mentioned earlier, and we spoke with Khosla Ventures co-founder Vinod Khosla about the state of the VC ecosystem since that time. He joined Bloomberg Technology earlier today. Take a listen.
The net result has been minimal, to be honest. People have moved on. They have other banking sources. Some of the people involved in Silicon Valley Bank are still around, working for other firms or other entities. And life goes on. The Valley has adjusted.
You noted there were other sources of banking. You know, it brought names like Mercury, some what I would call alternative lending or transaction services to the fore. But if there was a lesson learned, it was the high concentration at SVB, right? If you were, an early stage startup, you had your banking there, but you probably had some debt there as well, or lending. And it was often the first place you could get a check. Is that concentration risk still there?
You know, so the risk with Silicon Valley Bank had nothing to do with Silicon Valley and startups. It had to do with interest rate speculation, which the bank did. So I want to separate irresponsible actions on their part on the interest rate side from what the business was. I think the business was a solid business, and most of it has continued in the same way. I don't think it has changed dramatically. The alternative banks, Mercury and others, came up, but there's other banks that are still the principal banks for startups in the Valley. I don't know if there's as much concentration, but we don't worry about that too much.
Vinod, what's been interesting is perhaps there was a moment of realization in a time of a crisis, who could you depend on? There is so much fierce competition to get in money to the right startup. Yes, that competition perhaps faded a little bit as the economy turned direction. But more broadly, has it brought you more business, do you think, by the fact that you were able to stick your neck out early and say, I'm here and I've got your back?
Well, that was what was most disappointing about the venture community for me. I called a number of other leading venture capital firms and said we should all support our companies. It's a temporary crisis, a couple of weeks maybe, but I didn't get a lot of support, so we had to unilaterally go out and say for our portfolio companies where we were major investors or lead investors, we would support all of them. I think every firm should have done that because venture likes to talk about how they help their portfolio companies. But when the going got tough, most people didn't stand up to that scrutiny.
That was Vinod Khosla speaking with Bloomberg's Ed Ludlow and Caroline Hyde on Bloomberg Technology earlier today. Now, more than 40 years ago, Oracle was a startup. It's no longer a startup. It's one of the biggest tech companies out there, and it has just reported its quarterly results. And what we can tell you is that when it comes to the numbers, Oracle has given a third quarter adjusted revenue of $13.28 billion that matches the average analyst estimate. The operating margin, however, for that third quarter was 44% when analysts were looking for 42.9%. And that might be a big reason why the stock is moving higher in after hours trading. For more, we're joined now by Brent Thill. He is equity research analyst over at Jefferies. Brent has a buy recommendation with a $145 price target. Again, Oracle right now rising in the after hours trade here. And it does mention AI demand as a big issue, as a big booster here. And we will continue to, of course, monitor those headlines for you, especially as we head towards the earnings call. Brent is not available at the moment, but we'll check in with him a little bit later on. In the meantime, coming up, the case of the missing princess. The top three is next, where we focus in on the top three movers and shakers at the center of the day's biggest stories. This is The Close on Bloomberg. All right, we now have Brent Thill back with us. He is equity research analyst over at Jefferies with a buy recommendation on Oracle and a price target of $145. Brent, we're looking at Oracle shares moving higher in after hours trading. There's a lot of focus on the cloud computing business and whether it's stabilized after growth had slowed down, the growth rate had slowed down at least. What are you seeing from this earnings report that gives you confidence?
Yeah, I mean, Oracle had a really tough first half of the year. Q3, they delivered a little bit better numbers. They're not amazing, but certainly better than feared. They're going into their seasonally strong fourth quarter. Their OCI business, which is their cloud infrastructure business, showed good growth in the low 50% growth rate, and the street was looking somewhere in the high 40s. So growth a little bit better. I think their RPO, which is their backlog, inflected 29% year over year versus 7% last quarter. So that's a good inflection. And so I think, again, you have a kind of a tale of first half, really tough execution. And now we're seeing improve. Remember, we've seen Amazon, Microsoft, and Google all talk about their cloud businesses starting to reaccelerate, cloud optimization headwinds abating. We believe that this is a good thing for Oracle and their infrastructure business. And then you look at the application business where they compete against Workday, SAP, and Salesforce. All those companies are doing well. We're seeing more offensive IT budget spends come back versus the we saw last year. So we're seeing what we see is slightly better numbers. Nothing to get super excited about. We still think Amazon, Microsoft, and Salesforce are better investment ideas, but right now is underweight Oracle. So a little bit better. You're seeing a little bit of a relief rally given how poor performed.
Now, of course, I got to ask you about AI as well, because Oracle said that demand for our Gen 2 AI infrastructure substantially exceeds supply. Obviously, Gen AI is the theme for this earnings season, and customers are excited about it. But as a source of revenue, at what point does it become meaningful to you?
Well, they've said it's not meaningful at all. It's zero. it basically doesn't convert to revenue until the back half of this year. So remember, everyone's on this AI hype train. Oracle's been saying the same thing for the last 2-3 quarters, and they haven't delivered. So when you think about what they're saying and what the delivery is, it's two different things, and that's why the stock has lagged. Yes, there's incredible demand across all of our companies we cover, but I think the question will be, can they deliver a product that is as good or equivalent to that of Microsoft and Amazon? And we think the answer is no, they won't. We think but we think that they will deliver, and they'll be one of many clouds. Remember, they're on a $6 or $7 billion cloud infrastructure run rate.
Yeah,
Amazon's $1 billion. I mean, this is like not even comparison. They're so far. So right now, I think Oracle, again, we like it because it's cheap. We think that investors, have been underweight or short the stock. We feel like they're kind of getting their act together. You never want to bet against Oracle going into a seasonally strong fourth quarter, which is May. In the history for 20 years, they're going into that May quarter. So I think the stock's leaf rally, but there's no big breakout here. Stay with Microsoft, Oracle, and Salesforce.com. All
right, Brent Thill, really appreciate it. Brent Thill with a buy rating on Oracle, but he sees the other cloud infrastructure plays perhaps as better bets in the meantime. It is time now for the top three, where we take a deep dive into the folks at the center of some of the day's top stories. And first up is Kate Middleton, the Princess of Wales, who hasn't been seen in public since December before her abdominal surgery in January, which raises a lot of questions, or raised questions online about her health. Until this past weekend, because on Sunday, Kensington Palace released a photo of the princess with her 3 children to mark Mother's Day in the UK. That should have been the end of the story, except royal watchers noticed some oddities, like the uneven sleeve on her daughter and even Kate's missing wedding ring. 4 media agencies then pulled the photo, saying the image had been manipulated. Kate eventually released a statement saying she occasionally experiments with editing and she did digitally alter the photo. Mystery solved. Next up, F1 driver Felipe Massa. His lawyers filed suit against F1 and the auto racing governing body over a crash that he claims cost him the 2008 championship. Massa is also seeking a minimum of $82 million in damages. The Brazilian driver lost the race to Lewis Hamilton by 1 point back then. And finally, Christopher Nolan, the director of Oppenheimer, won his first Oscar last night. The film itself picked up a total of 7 awards, including Best Picture and Best Actor for Cillian Murphy. So congratulations to the Oppenheimer crew. We're going to stick with Hollywood here because finance giants from Blackstone to Apollo and Bain are about to find out if their billions of dollars betting on added space for production will pay off, with cities from Los Angeles to New York adding millions of square feet for film lots. Bloomberg's Sally Bakewell joins us now to discuss. So, Sally, this is a story where they actually invested in physical infrastructure, and it's coming at a time when a lot of the media companies are cutting costs.
That's right. So they made this big bet on these studios, these sound studios, thinking that the demand for sort of increased film and TV output that we saw very much during the pandemic when everyone was shut at home and continued after the pandemic for services like Netflix and Hulu would be nearly endless. And we have the likes of Apollo, which has loaned about $480 million for a 16 soundstage project in Burbank, California, which is under construction. Bain Capital is involved in a joint venture, and Blackstone also is pressing ahead with a project. But what the problem is, or the issue could be, that all of this growth, and in places like New York, we have sort of 11 facilities being built. In Georgia, facilities are up about 100-fold. This growth is colliding with a potential sort of peak TV moment where the demand is potentially starting to fade, with some of the producers reducing production of their original shows, with a lot of big companies like Disney facing investor pressure and paring back. And so they're sort of meeting this shake-up moment that could be very telling for this big bet they've made.
Okay, to be fair, there's no financial issue just yet, right? There's no issue with the default or distress. It's just this overall sense that demand is going to start slowing down quite a bit.
Yeah, that's right. There is no sort of, for the existing studios which are there is no imminent threat that people are worried about. And indeed, those interviewed in the story that we put out today sort of say that this is very much the industry. There are kind of waves and troughs and peaks, and this is just what they're going to ride through. And that if you're in the right locations, like Hollywood, like London, like New York, you can weather the storm.
Right. But in other places, and you mentioned Atlanta, for instance, it might be a bigger issue. Tyler Perry, of course, has built out some big facilities there, and it's something that bears watching. Sally, thank you so much. much. Sally Bakewell, of course, with the finance team on how private equity firms ranging from Apollo to Blackstone have been betting on Hollywood. But with the fate of peak TV, maybe that's a bet that's worth watching to see if it pays out. Coming up on the close, we've got U.S. CPI data tomorrow, and that's what everyone in the markets are waiting for. It's going to give us a read on inflation. So we're going to take a look ahead at what to expect. Sarah Wolfe, the U.S. economist over at Morgan Stanley, will be joining us with her take on what we should be looking for. This is The Close on Bloomberg. Welcome back to The Close. I'm Scarlett Fu. Let's talk about the IPO market because Reddit has filed to go public with an initial offering of 22 million shares priced between $31 and $34 a share. That would give it a valuation of up to $6.4 billion. Joining us now for more is Bloomberg's Amy Orr. So, Amy, we know that Reddit, based on your reporting, was aiming to get a valuation of at least $5 billion. So it's looking like that Reddit can deliver on what it had promised.
Yeah. So right now, the valuation on a fully diluted basis is $6.4 billion. And essentially, we reported earlier it was above 5. So it's better, but then it's still like a bit away from the $10 billion that it was aiming for back in 2021 when it first filed confidentially for a U.S. listing.
So that's where I want to go because that confidential listing was back in late 2021. Why move forward to go public now? What is the calculus here in terms of the timing of going public?
So the market has tanked, and we haven't been having great IPO market for a very long time. And then I think this is now the window that a lot of people are seeing. So right now, Reddit is on the road, and also Astera Labs as well, which is seeking for around 530 million. So a lot of people are looking at the S&P and how it's still edging up, despite having went up like 24% last year. So and the equity capital market is red hot. Like we've got 2 whole weeks of like $10 billion in both like secondary share sale and convertible bond issuances. So like in terms of the market, the conditions are there. So it's really up to investors whether they're going to put money to work in Reddit or not.
So in 2023, Reddit was losing money. It did for the full year, albeit less money than before. Has it articulated a plan to turn profitable?
So it's already profitable for the fourth quarter, so it makes it actually profitable for the second half.
Okay.
They haven't actually come out with a projection because they can't really project too much during IPO period, but it's very likely that it will. Part of the reason why is they've actually diversified beyond just advertising. They are also selling like data for Google and other companies to actually allow their AI to learn from the vast treasure trove of 18 years of data that Reddit has. So that is going to become a much more kind of good driver for the revenue going forward as well.
And of course, one reason why this IPO would be different than others is because Reddit users will have access to the listing as well. What do we know about that?
It's very true. So Reddit being the place where like meme stocks actually happened and started, and then it's trying to actually garner that support and use it on itself. So 8% of the deal is actually going to direct share sale to Reddit users and heavy moderators, users of the company that has registered before the beginning of this year. So we'll see. And there were already talk like among Redditors saying like, oh, we don't really like it. We don't like the valuation is a bit too aggressive. And also the fact that they kind of feel like we've toiled for you guys. And then you're just like banking on the work that we do. But yeah, we'll see whether it's going to play out.
Of course, and they can talk about it in their various Reddit forums as well, right? Complain about the valuation. Amy, thank you so much. And of course, we'll be keeping an eye on this. When is it expected to start trading?
March 21.
March 21st, so the day after the FOMC. Amy Orr, thank you so much. Amy, of course, covers IPOs for us. I was thinking ahead because we have the CPI report due out tomorrow, and that's going to be out at 8:30 a.m. New York time, so clearly going to be a market tone-setting event. Let's bring in now Sarah Wolfe, U.S. economist over at Morgan Stanley. Sarah, there's a lot of anticipation before this report, even though the Fed takes this data point in consideration with other inflation data points. What are you anticipating for tomorrow?
We're looking for the data print tomorrow for February CPI to show that the January CPI report, which was quite hot and stronger than expectations, was really a bump in the road and not a new trend. So we're looking for something a little bit below the 0.3, similar to what we were seeing in November and December and what Chair Powell would classify as good data that he needs to get confident that we're on our way to 2%.
Okay, and when it comes to core prices, and that's when you back out food and energy, it actually is going to have a stronger print, a higher print than what we get for the headline number here. 3.7% is the expected read for the month of February. Talk us through what we've seen in the energy markets and how that impacts CPI.
We are seeing some upswing in energy prices, and that's going to be leading into a higher month-over-month print for headline, even though the year-over-year is going to be coming down more for core. Of course, we do try to look through food and energy prices and just focus on core. The Fed was looking at headline when food and energy prices were a really big impact on consumers and what businesses were doing, but right now we're just seeing a lot of back-and-forth volatility. Energy prices were down last month, now they're up this month.
What kind of consistency do you expect to see between CPI and PPI? Because as you mentioned, the January data was hot for both CPI and PPI and raised a lot of concerns about what is happening with the outlook for price gains and whether the Fed can actually move ahead with the rate cuts.
PPI is going to be critical for some of these services components in the core services basket. So what we saw last month that was really concerning is not only was core CPI strong, but that core services component was strong, and that was strong for CPI and PCE. PCE, remember, pulls in CPI components and PPI components. And we saw very hot financial services, airfares, those are all from PPI. So we're going to get the first look at what PCE should look like in February, but then in a couple of days when we get PPI, we'll get the final details on core services, which are what's very important, continues to cool, not what we saw in January.
Okay, so these will be the final two data points that the Fed really takes into account before its meeting on February 20th and its decision, of course, on the 20th. Retail sales will come out on Thursday, and I know that we keep talking about how robust the consumer is doing and how solid and a source of strength that the consumer is for the U.S. economy. Is there reason to believe that the retail sales report could disappoint in any way?
We're looking for that control group that feeds into consumer spending to actually be fairly soft. So 0.1% on the month. It's not the negative 0.4 that we got last month. But I think what's really notable is what's tracking within the consumption basket. So we're looking at just over 2% real PCE for this quarter. That's a slowdown from 3% last quarter. In the details, though, goods are tracking very weak, just 0.1% for us, whereas services are over 3%. So what we're seeing is that consumer spending is slowing, not falling off a cliff, still a healthy consumer, but there's a choice happening, and it's away from retail and towards services, and that's coming through in the first quarter consumer spending data.
Yeah, so that discretionary spending is really coming through in various data points. So if you put it all together, how are you thinking about how the Fed changes up its messaging come March 20th? Because it's been very consistent saying, we are willing to be patient. We want to see more good data, not necessarily better data, just more good data.
I don't think the Chair Powell and the participants need to change their messaging very much, right? They need to see more good data. I think if we get another very hot print on CPI tomorrow, it does start to worry participants, especially those hawks that we need to come down in order to deliver that first cut, right? We need to get consensus among the FOMC. If we get another very strong print tomorrow, it's going to make it more and more difficult for the FOMC to come together for that first cut. But if we get something in line with our expectations, about a 0.3 or so on core CPI, Chair Powell does not need to change his message. We need more good data, but we're going to be patient and careful when delivering the first cut. With a very strong economy and a very strong labor market, there's really no rush, in their opinion, in bringing in that first cut. And so we need a few more data prints. We actually get 3 more CPI reports before the June meeting, which is when we expect to see the first cut. That doesn't include the data that they get that morning of the meeting. So there's quite a bit of data that they have between now and June, in our opinion.
And when do we get an update on their economic projections and how they're thinking through what the trajectory of growth and price increases look like?
It's likely that they're going to revise up their growth a little bit. They were at 1.4. Maybe they bring that up to about 1.8. Inflation, they don't really need to change very much. They were at 2.4. It could come down a little bit depending on how the report looks tomorrow. But, we had strong January, but then we know that a lot of FOMC participants are building in the new tenants index, which shows softer shelter inflation in the back half of the year. So that offsets some of the rise in the inflation projections from January. So it could on net just end up at 2.4. What I do expect to see in the dots, so the projections, that we could see some convergence in the dots. The median stays the same at 3 cuts. The average stays the same, but some of those outliers on each end may come closer to the middle as we get closer to building that consensus on the first cut.
Right. It's a long road, or it has been a long road for Chair Powell to build that consensus. Sarah, really appreciate your joining us today.
Thanks for having me.
Sarah Wolfe is U.S. economist over at Morgan Stanley, giving us a preview into tomorrow's CPI report. Let's just get another check here on Oracle shares, because they were moving higher on the stronger than expected margin number for the fiscal third quarter. You can see the stock now up 10% in after hours trading after the cloud revenue in particular beat the average analyst estimate. And Oracle did make some comments about AI as well. Demand for Gen 2 AI substantially exceeding supply, even as it's something that doesn't contribute to revenue or the bottom line. For now. Let's also take a look at how the broader market closed on the day. It was a day in which the stock rally stalled. We had 16 record closes for the S&P 500, but we didn't get there today. The S&P 500 losing 0.1%, and that was kind of the story across all the major indexes except for the Dow Industrials. Treasuries also moving lower, so yield goes up by 2 basis points to 4.09%. What is defying the decline is Bitcoin. It continues to move north. Bitcoin now at $72,222. This is the close on Bloomberg. President Joe Biden today laying out his budget proposal for fiscal year 2025. It's really a vision that would deliver more services, middle-class tax breaks, and price controls to voters, funded through higher taxes on the wealthy and companies. Joining us now for more is Bloomberg Balance of Power co-host Kelly Lyons. Kelly, this is really a wish list because it's a proposal, and it strikes a big contrast with what former President Trump and presidential candidate Donald Trump is anticipating.
Yeah, absolutely, Scarlett. We've been describing this here in Washington as aspirational because really this budget proposal from the White House is more politically signaling than anything else. $7.3 trillion for fiscal year 2025 is what the White House is requesting. Of that, about $1.7 trillion is discretionary spending. Defense, a huge chunk of that, almost $900 billion. But the White House says this proposal actually will cut the deficit by $3 trillion over the next 10 years. And as you alluded to, primarily that is driven by the revenue side. They want to raise taxes on billionaires, on corporations. He wants to see a minimum tax rate of 25% for billionaires, raise the corporate tax rate to 28% and put in place a 21% minimum. This would raise taxes on stock buybacks, for example, as well as taxes on profits for multinationals that are made abroad. That is all to fund programs that the president would like to see: more affordable housing, childcare, universal pre-K. A lot in here around lowering prescription drug costs as well. The problem is, Scarlett, you need Congress to pass all of those things. And while this is what the president says he would like to see, it would be very difficult to actually get over the finish line in a divided Congress with Republicans in control of the House of Representatives. And it's worth keeping in mind on that point. This is the budget for fiscal year 2025. Congress still hasn't actually passed all of the appropriations for the fiscal year we're in now. The next deadline they face doing that, passing 6 different appropriation bills, is March 22nd, when we're almost halfway into fiscal year 2024.
Yeah, it's a good reminder that this is aspirational, as you put it, a wish list, really, of sorts. One thing that we should mention as well is that even though it feels like the presidential contest is pretty much set, there are still primaries that are taking place on the calendar for tomorrow.
Yeah, Georgia is going to be one to watch. That is a place for President Biden where he's likely to win the Democratic primary. Of course, he's won all of them thus far, but whether or not he still is able to galvanize support among black voters in particular. And in the case of Donald Trump, we're looking to see if he could actually lock in the Republican nomination tomorrow. Remember, 1,215 delegates are what is needed to actually be the presumptive nominee. And Super Tuesday had gotten him very close. He has more than 1,000. Could he actually seal the deal tomorrow is what we're going to be watching for. And it speaks speaks to a contrast, of course, between a former president and a current president already in a very long general election campaign for all intents and purposes. They were both in Georgia over this past weekend, and Biden is making his way through several other swing states over the course of the next several days as well.
All right, a good recap there of what we can anticipate for tomorrow. Kaylee Lyons, thank you so much. And of course, catch Kaylee and co-host Joe Matthew at the top of the next hour for Balance of Power. Now, we're going to stay with politics because on the corporate front, one company is starting to hire the immigrants who are seeking asylum and overwhelming big cities across America. Bloomberg's Simone Foxman is reporting on how meatpacker Tyson Foods is capitalizing on this inflow. And Simone, this is one of the stories that really got my attention this morning on the Bloomberg terminal. We know that critics of the White House talk about New York City migrants as illegal, but your story actually points out that they have work authorization. Walk us through what that means.
So these are asylum seekers or people applying for a very similar temporary protected status. So they apply for asylum and then they wait. But that application for asylum starts a ticking clock. And so most of them will have work authorization within 6 months. That said, they may wait for years for their very first immigration court date. And it's a good thing, frankly, for them to be able to work. It doesn't mean that they're on social services provided by New York City or elsewhere. It means that they have papers, they can go get a job, be documented workers. And this, it turns out, is actually a pretty attractive source of potential workers for places like Tyson.
So why does Tyson have these, what seems to be immense hiring demands?
So it has a turnover rate of 40%, meaning 4 in 10 of its workers every year on its what it calls its frontline workers, the folks who are, washing the chicken, looking for bones, packing it up into trays. Very few of them are going to stick around in the long term. So it needs to hire something like 52,000 people this year. It already employs about 42,000 immigrants and refugees, but it sees this part of the workforce as a particularly good one for immigrants. They like to stay. They've often come from very difficult situations, and so the company is really investing in a lot of services for them, whether it's English language classes, certain childcare services, to try and convince them, come stay. You may make only $16.50 an hour to start, but this is a good job.
And this is a stable job. I can't get my words out today. So you were at a Tyson fair in New York City not so long ago where Tyson was basically making this pitch. What did you observe when you went there?
Yeah, so this is a fair put on by Tent Partnership for Refugees. This is a foundation. It's backed by the founder of Chobani. And what they did is they went out, they created a database for these new asylum seekers in New York City specifically. They recorded all their documents. And so Tyson reached out to them. They went through their database. They went through the list, said, you meet the work authorization criteria. You want to relocate. And we think also that you'll meet our physical. So these people would come in. They'd learn a little bit about the company. And for the most part, Tyson had already gone through their various details of their application. And so many of them, 17 the day I was there, and then another 70 a couple weeks later, went off to Tennessee to go start their new jobs as Tyson production workers.
So wrap this all up for us. How do these hiring programs play into the larger debate on immigration that's taking place, across our political society?
We said it earlier. Illegal is a very charged term, right? Companies like Tyson have extraordinary hiring needs, and right now there's a shortage. There's 9 million open jobs. This, according to some reporting that Enda Curran and Augusta Saraiva did last week. These companies are going to look for workers as well as they can. They're going to start looking at this potential workforce of people who are here indefinitely with legal authorization to kind of fill those jobs legally. Now, what does this say about the system? Does it create perverse incentives? These are the kinds of questions that we need to asking ourselves. But, if Congress is not able to move forward on this, this is the way things are going. And it looks like programs like this one are likely to become important to how these jobs get staffed.
Yeah, especially given that Tyson needs to hire more people than it has working for it right now, which is a pretty incredible number.
They have 100,000 U.S. workers in this wage class. But if they're going through so many, then of course.
Yeah, 40% turnover will do it. Simone Foxman, thank you so much. And be sure to read Simone's story, Tyson is hiring New York immigrants for jobs no one else wants, on the Bloomberg terminal and at Bloomberg.com. Now, still ahead on the close, what investors need to watch for in tomorrow's trade. This is Bloomberg. One big thing investors will be looking out for on Tuesday, Kohl's results, which will be out in the morning before the opening bell. Joining us now is Mary Ross Gilbert, Bloomberg Intelligence Senior Equity Research Analyst. And Mary, we're at the tail end of retailers reporting earnings. What is Kohl's likely to say about the quarter that ended?
Yeah, so we think that in the quarter, consensus is looking for earnings of about $1.29. Could they exceed that? We think that's possible. They're looking for sales to be down less than 1% with comp sales, which is like same-store sales, but it includes online. And that's expected to be down 3%. And it might be a little bit better. What's really happening there is they're going against a year ago when they had online-only promotions that really drove strong digital revenues. Mm-hmm. And so this whole year, we've been experiencing double-digit declines in online sales. That's going to be behind them, too, as we look out to 2024.
Okay, so difficult comps for Kohl's there. We know within the retail space, Macy's is facing pressure from investors to go private and also to do something about its real estate. How does that affect a company like Kohl's?
Yeah, so that's a great question, Scarlett, because what we saw in early February, and this kind of came after the Macy's news, is that there were some new investors that took a position in Kohl's, including Vision One and also a Singapore sovereign wealth fund. And the Vision One fund investor there was saying, hey, we want to push for Kohl's to sell itself. Mm-hmm. And remember a couple of years ago, in 2022, Kohl's was in play and it was related to their real estate. And the real estate we value at about $6 billion. Macy's, just to remind you, we value at about $8 billion. Again, we're only valuing properties that are owned in fee, so it doesn't include buildings on leased land or any under market leases. So there is embedded value here, and of course that's the case with Kohl's. In 2022, the values that we were talking about are, were somewhere in that $60 to $70 range, and you can see where the shares are today.
Yeah, well, it's something we'll keep an eye on for sure as Kohl's gets ready to report earnings tomorrow before the bell. Mary Ross Gilbert, really appreciate your joining us. Mary Ross Gilbert with Bloomberg Intelligence. Now let's look ahead to what else we're keeping an eye on tomorrow. EU finance ministers will be meeting in Brussels. We'll, of course, give you those headlines when they cross. And then at 8:30 a.m., it's the big report, the big data point, which is inflation for the month of February. And it's a big issue because in January, we had both hotter than expected CPI and PPI, which really surprised investors. On the political diary, we've got primaries in states like Georgia, Washington, and Mississippi. Perhaps former President Trump will lock up the nomination for the Republicans. And before the bell, we get earnings out of Kohl's. That does it for us. Balance of Power is up next. Have a great evening. This is The Close on Bloomberg.